Something has shifted in the financial markets. Not overnight, not with drama, but with the kind of quiet persistence that usually precedes meaningful change. If you hold silver, or if you've been watching it from the sidelines, this moment deserves your attention. And not because I'm here to promise you wealth or predict the future, but because the conditions surrounding this metal have reached a point where understanding what's actually happening matters more than reacting to what everyone is saying. Silver has corrected. Again. For some, this feels like disappointment. For others, vindication that precious metals never work. But if you understand market cycles, monetary history, and the forces currently reshaping global finance, you know that corrections in long-term bull markets aren't endings. They're mechanisms. They're tests. And they're often the final shakeout before the next significant move. I'm not here to tell you what silver will do tomorrow or next month. I'm here to walk you through what's actually changed, what most people are missing, and how disciplined investors think during moments like this. Because the truth is, most people lose money, not because they picked the wrong asset, but because they didn't understand the cycle they were in. This is a conversation about probability, preparation, and perspective. Whether you're holding physical silver, considering your first purchase, or simply trying to understand what's happening in the broader financial system, the next 25 minutes will give you clarity. Not hype, just signal in a world full of noise. Let's begin. To understand where we are, we need to be honest about what's happened recently. Silver experienced a sharp correction after testing multi-year highs. The price pulled back significantly from levels that had many investors excited and skeptics nervous. This wasn't a gentle drift lower, it was decisive, the kind of move that shakes conviction and creates doubt. But here's what most commentary misses. Corrections like this don't happen in isolation. They happen within context. And the context surrounding silver right now is unlike anything we've seen in decades. Global debt has reached levels that would have been considered impossible 20 years ago. We're not talking about small increases. We're talking about exponential expansion across sovereign, corporate, and consumer debt. The United States alone carries debt that exceeds its entire economic output. And the interest payments on that debt are now one of the largest budget items the government faces. Central banks, which spent years trying to normalize interest rates after the 2008 crisis, were forced back into extraordinary monetary policy far sooner than anyone expected. Rates were raised aggressively to combat inflation. Then, as economic stress mounted and banking system fragility became apparent, the conversation shifted. Now we're watching carefully choreographed language about pauses, pivots, and the eventual need for accommodation. This matters for silver because silver is not just an industrial metal, it's a monetary metal with a 4,000-year history of preserving value when currency systems come under pressure. And right now, currency systems are under pressure. The dollar, despite remaining the global reserve currency, faces structural challenges that are no longer theoretical. Foreign central banks are diversifying reserves. Trade is increasingly being settled outside traditional dollar channels. Trust in the long-term stability of fiat currencies is eroding, not because of conspiracy theories, but because of simple mathematics. You cannot expand the money supply indefinitely without consequences. At the same time, industrial demand for silver continues to grow. Solar panel production, electric vehicle manufacturing, 5G infrastructure, medical applications. These aren't speculative future uses. They're current, real, and accelerating. Silver's unique properties make it irreplaceable in many of these technologies. So we have a metal that serves two masters, industry and monetary history, and both demand drivers are strengthening while above-ground supply remains limited. The correction didn't happen because these fundamentals disappeared. It happened because markets are emotional, leveraged, and reactive. Short-term traders took profits. Algorithms triggered selling. Sentiment shifted from euphoria to skepticism. This is normal. This is how markets work. And this is exactly the kind of behavior that creates opportunity for those who understand what they're watching. Let me tell you what happens to most people during market corrections. They panic when prices fall, convinced they've made a mistake, or they smugly declare they were right to stay away, using short-term price action as evidence that the entire thesis was wrong. Both responses come from the same source, a misunderstanding of how markets actually move over time. Markets don't rise in straight lines. They never have. Every significant bull market in history has been punctuated by corrections that felt, in the moment, like the end. Gold in the 1970s, tech stocks in the 1990s, real estate before 2008, Bitcoin between 2015 and 2020. The pattern repeats because human psychology repeats. We are wired to seek immediate feedback. We want confirmation that our decisions were correct, preferably within days or weeks. But commodity cycles, especially in monetary metals, don't operate on human emotional timelines. They operate on economic cycles that unfold over years, sometimes decades. Silver is particularly susceptible to volatility because the market is relatively small. It doesn't take massive capital flows to move the price significantly. This creates wild swings that confuse people who are used to more stable asset classes. But that volatility works both directions. The same small market that allows for sharp corrections also allows for explosive moves higher when sentiment and fundamentals align. Most people also misunderstand what drives silver's price over the long term. They focus on daily news, technical patterns, and short-term trader sentiment. These things matter for timing, but they're not the foundation. The foundation is monetary physics. When government debt becomes unsustainable, when currency debasement accelerates, when trust in financial institutions erodes, people seek stores of value outside the system. Historically, they've chosen gold and silver. Right now, we're in a period where those exact conditions are building. But the mainstream conversation hasn't caught up yet. Most financial commentary still treats precious metals as relics, as speculative side bets for gold bugs and conspiracy theorists. This dismissiveness creates opportunity because it means the crowd hasn't arrived yet. Think about what happens in every major market move. The early participants are mocked or ignored. The asset climbs slowly with corrections that shake out weak hands. Then, suddenly, the narrative changes. What was dismissed becomes accepted. What was ignored becomes urgent. And by the time the crowd arrives, the easy gains are gone. We're still in the phase where silver is largely ignored by mainstream finance. Yes, there are enthusiasts and dedicated investors, but we haven't seen pension funds, institutional capital, or widespread public interest. That's not a weakness. That's a sign we're still early in the cycle. The correction you're seeing isn't evidence that the thesis failed. It's evidence that the thesis hasn't been tested yet. It's the market doing what markets always do, shaking the tree before the fruit ripens. Let's talk about history, because history doesn't repeat, but it certainly rhymes. Silver has experienced several major bull markets in modern history. Each one was driven by different immediate catalysts, but the underlying conditions were remarkably similar. Debt crises, currency concerns, inflation fears, supply constraints. And each time, the move higher was preceded by exactly the kind of correction we're seeing now. In the late 1970s, silver went from under $2 to over $50 in a matter of years. But that move wasn't smooth. There were significant pullbacks along the way that convinced many investors to exit. Those who understood the macroeconomic forces, soaring inflation, dollar weakness, geopolitical instability, stayed positioned and witnessed one of the most dramatic commodity moves in history. After peaking in 1980, silver entered a brutal bear market that lasted 2 decades. This is important to understand. Markets overshoot in both directions. The 1980 peak was driven by speculation and mania, not just fundamentals. The subsequent decline was the market correcting that excess. But notice what happened next. In the early 2000s, as global debt expanded again and central banks embraced easy money policies, silver began a new bull market. From 2001 to 2011, it rose from around $4 to nearly $50 again. And once again, that journey included multiple corrections of 20, 30, even 40%. Each correction convinced many that the rally was over. Each correction was actually a consolidation before the next leg higher. After 2011, we entered another bear market. This one was different, though. Industrial demand remained strong. Mine supply peaked and began declining. But financial demand disappeared because investors believed central banks had everything under control. The narrative was that inflation was dead, that digital currency had replaced the need for monetary metals, that this time was different. That narrative is now cracking. Not because of speculation, but because reality is asserting itself. You cannot suppress interest rates indefinitely. You cannot expand debt exponentially without consequence. You cannot promise perpetual bailouts without eroding trust in the currency itself. We're now in the early stages of what could be the third major silver bull market in 50 years. And if history is any guide, this one will be characterized by the same volatility, the same corrections, and the same psychological tests that define the previous cycles. The difference this time is the scale of the underlying imbalances. Global debt is higher. Monetary expansion has been more extreme. Trust in institutions is lower. And the industrial demand side of silver's equation is stronger than it's ever been. None of this guarantees a specific price target or timeline, but it does suggest that the probability of significantly higher prices over the next several years is high. And it suggests that corrections like the current one are features, not bugs. They're the mechanism by which markets transfer silver from weak hands to strong hands, from emotional traders to patient accumulators. If you study market cycles, you learn that the most difficult time to hold an asset is often right before it enters its strongest phase. The pain of drawdowns, the doubt that creeps in, the opportunity cost of watching other assets rise, these psychological factors are precisely what create the shakeout. And shakeouts are necessary because markets need fuel. That fuel comes from people who sell low and then watch the asset rise without them. Now let's examine the specific forces that make this moment different from ordinary market volatility. First, inflation. The official narrative is that inflation has been tamed, that we've returned to normal. But this perspective relies on heavily manipulated government statistics that exclude or underweight the items people actually spend money on. Real inflation, the kind you experience when you buy food, pay rent, purchase insurance, or maintain a vehicle, remains elevated and is likely to stay that way. Why? Because the solutions to inflation require pain that political systems are unwilling to accept. True disinflation requires sustained high interest rates, reduced government spending, and a period of economic contraction. Every time we approach these conditions, the pressure to reverse course becomes overwhelming. Jobs are threatened, markets wobble, politicians face voter anger, and so the easy money returns. This creates a ratchet effect. Inflation rises, policy tightens briefly. Inflation cools slightly, policy eases again. But each cycle leaves prices permanently higher than before. Your purchasing power erodes steadily, even if year-over-year inflation numbers moderate. Silver, like gold, is one of the few assets with a 4,000-year track record of maintaining purchasing power through these cycles. This isn't speculation, it's historical fact. An ounce of silver has roughly maintained its value against basic goods across centuries, while every fiat currency has eventually failed or been dramatically devalued. Second, debt sustainability. This is perhaps the most important factor that most analysis overlooks. The United States, Europe, Japan, and China all face versions of the same problem: debt levels that cannot be serviced at historically normal interest rates. Think about what this means. If interest rates remain at levels considered normal before 2008, government interest expenses become unsustainable, deficits explode, debt spirals. The only solutions are default, which is politically impossible for major nations, or monetary expansion, which is inflation by another name. We're watching this play out in real time. Despite all the talk of fighting inflation, central banks know they're trapped. They cannot allow genuine deflation because deflation makes debt more burdensome. They cannot allow interest rates to normalize because normalization bankrupts governments. Their only path forward is to manage the decline, to inflate gradually rather than catastrophically. This is the environment where monetary metals thrive, not because of conspiracy, but because of mathematics. Third, currency debasement. The dollar remains the global reserve currency, but that status is eroding at the margins. This doesn't mean the dollar collapses tomorrow. It means alternatives are being built, tested, and slowly adopted. Central bank digital currencies, gold-backed trade settlements, direct bilateral currency swaps that bypass the dollar entirely. Each of these developments chips away at dollar dominance. And as that dominance erodes, the need for alternative stores of value increases. Silver sits at the intersection of industrial utility and monetary history, making it uniquely positioned for this transition. Fourth, supply and demand fundamentals. Above-ground silver inventories have been declining. Mine production has plateaued. Recycling can't keep pace with demand. Meanwhile, industrial applications are accelerating. The solar industry alone is projected to consume massive quantities of silver over the next decade. Electric vehicles require significantly more silver than traditional cars. 5G infrastructure is silver intensive. This creates a structural deficit that financial markets haven't fully priced in yet. When they do, when institutional capital begins to recognize that silver is both industrially critical and monetarily relevant, the price discovery could be dramatic. None of these factors exist in isolation. They're interconnected. Debt drives monetary expansion. Monetary expansion drives currency concerns. Currency concerns drive demand for real assets. And real assets with supply constraints see the most dramatic price appreciation. The current correction is happening against this backdrop. The fundamentals haven't weakened. If anything, they've strengthened. What we're seeing is simply the market's emotional response to short-term price action, overlaid on algorithms and leverage. This is noise. The signal is what we just discussed. If you're already positioned in silver, this section is for you. First, understand that corrections test conviction. They're designed to. If investing were easy, if assets simply rose without interruption, everyone would be wealthy. The difficulty is the mechanism. It ensures that only those with genuine understanding and emotional discipline capture the returns. Right now, you're being tested. The price has pulled back. Maybe you're underwater on recent purchases. Maybe you're watching unrealized gains evaporate. Maybe you're questioning whether you made a mistake. These feelings are normal. They're also irrelevant to whether your thesis is correct. Ask yourself, has anything fundamental changed? Are governments suddenly running surpluses? Have central banks found a way to reduce debt without consequences? Has industrial demand for silver collapsed? Has new supply flooded the market? If the answer to these questions is no, then the correction is simply volatility, not invalidation. This is where emotional control separates successful investors from unsuccessful ones. Unsuccessful investors base decisions on feelings. They buy when they feel confident and sell when they feel afraid. This guarantees they buy high and sell low. Successful investors base decisions on analysis. When analysis says conditions are favorable and the thesis intact, short-term price action becomes irrelevant. If you hold physical silver, nothing has changed except the paper price. Your metal still exists. Its properties haven't degraded. Its monetary history hasn't been erased. Its industrial applications haven't disappeared. You're simply seeing the market reprice it temporarily based on sentiment and leverage. If you're considering adding to your position, corrections offer opportunity. This is basic mathematics. If you believe silver is worth significantly more over time, buying during weakness rather than strength improves your long-term returns. But only if you're using capital you don't need for years, and only if you're not over-leveraged. This brings us to an important point about leverage. If you've bought silver with borrowed money on margin or through leveraged instruments, corrections become existential. You can be right about the long-term direction and still get wiped out by short-term volatility. This is why disciplined investors in volatile assets avoid leverage. The cost of being forced out before the thesis plays out is too high. For those holding physical metal, the playbook is simple. Do nothing. Continue living your life. Continue educating yourself. Continue building financial resilience in other areas. Let the market do what markets do. Your metal isn't going anywhere. And if the thesis is correct, neither should you. For those holding paper silver through ETFs or mining stocks, the volatility is often more extreme. Mining stocks in particular can swing wildly because their leverage plays on the underlying metal. If silver drops 20%, mining stocks might drop 40 or 50%. This isn't a flaw, it's the nature of leverage. It works both directions. The key is understanding what you own and why you own it. If you bought mining stocks because you believed they'd make you rich quickly, you're gambling, not investing. If you bought them because you understood the leverage dynamics and positioned accordingly with proper risk management, then corrections are just part of the process. Above all, remember that patience is an edge. Most market participants don't have it. They need quick returns. They're investing money they'll need soon. They're emotionally fragile. This creates opportunity for those who can wait, who can endure volatility, who understand that meaningful returns in volatile assets come from holding through the uncomfortable periods. You're in one of those periods now. How you handle it will determine whether you capture the returns you're hoping for or join the majority who sell at the bottom and watch the next leg higher without them. If you don't yet hold silver but have been watching, this correction might feel like validation. See, you might think, I was right to wait. It did fall. I avoided loss. But here's the reality. Timing corrections is nearly impossible. Yes, the price is lower today than it was at the recent peak, but it's also higher than it was 2 years ago. And if the thesis we've discussed plays out, it will be substantially higher 2 years from now. The question isn't whether you avoided a correction. The question is whether you position yourself for the next cycle. Understand something about market entries. There's never a perfect time. Never. You will always be able to find reasons to wait. The price might go lower. The news might get worse. Another opportunity might present itself. This mentality keeps people on the sidelines indefinitely, watching others capture returns they convince themselves were too risky. Successful investors don't wait for perfect conditions. They wait for favorable probabilities, and then they act with appropriate position sizing. Right now, the probabilities favor silver over the medium to long term. Not because I'm predicting the future, but because the underlying conditions, debt, monetary policy, currency concerns, supply constraints, industrial demand, are aligned in ways that historically lead to higher prices. Does this mean you should invest everything you have into silver tomorrow? Absolutely not. It means silver deserves consideration as part of a diversified approach to preserving wealth and capturing potential upside in an increasingly unstable monetary environment. If you're new to silver, start with education. Understand the difference between physical metal and paper instruments. Understand storage considerations. Understand the volatility you're signing up for. Understand that this is not a get-rich-quick scheme, but a long-term position against currency debasement and systemic instability. Once you understand those factors, consider starting with a position that won't cause you emotional distress if it drops further. This is crucial. If you invest more than you can afford to lose, or more than you're comfortable holding through volatility, you will make emotional decisions. Emotional decisions in volatile markets are almost always wrong. Some investors follow a dollar-cost averaging approach, buying a set amount regularly regardless of price. This removes the timing stress and ensures you capture average prices over time. Others wait for significant corrections and add to positions during weakness. Both approaches work if executed with discipline. What doesn't work is buying out of fear when silver spikes and everyone is talking about it, then selling in despair when it corrects and everyone declares it dead. Yet this is exactly what most people do. Don't be most people. Consider silver as part of a broader strategy, not your entire strategy. Diversification isn't about owning multiple correlated stocks. It's about owning truly different assets that respond to different conditions. Silver performs well in environments where traditional financial assets struggle. That's its value in a portfolio. And remember, you're not just buying a commodity, You're buying insurance against monetary mismanagement. You're buying a claim on real value in a world of increasingly questionable paper promises. You're buying optionality if the monetary system experiences stress. The price you pay matters, but not as much as most people think. If silver goes to 60 or 80 or higher over the next several years, whether you bought at 25 or 30 won't determine your success. What will determine your success is whether you bought it all and whether you held through the volatility. This correction might continue. Prices might go lower before they go higher. Nobody knows. But if you're waiting for certainty, you'll wait forever. Markets never provide certainty. They provide probabilities. And right now, the probabilities favor those who position themselves in real assets before the broader market recognizes what's coming. Let's talk about what not to do, because avoiding mistakes is often more important than making perfect decisions. First, don't react emotionally to daily price movements. Silver will fluctuate, sometimes violently. If you check the price constantly and adjust your strategy based on short-term moves, you will lose. Emotional trading is the single biggest destroyer of wealth in volatile markets. Second, don't use leverage or margin unless you're an experienced trader who understands the risks completely. The temptation to amplify gains is strong, but leverage amplifies losses equally. More importantly, leverage can force you out of a winning position simply because of timing. You can be completely right about direction and still lose everything because you couldn't withstand the volatility. Third, don't invest money you need for short-term obligations. Silver is not a place for your rent money, your emergency fund, or capital you'll need within the next few years. It's volatile. It's illiquid compared to stocks. And you need to be able to hold through corrections without stress. Fourth, don't follow online hype blindly. The internet is full of people making bold predictions, setting price targets, claiming secret knowledge. Most of this is noise. Some of it is intentional manipulation. Make decisions based on fundamentals you understand, not on what anonymous accounts are saying. Fifth, don't ignore the rest of your financial life. Silver is one component of financial resilience. It's not a substitute for earning income, managing expenses, building skills, maintaining health, or nurturing relationships. Diversify your life, not just your portfolio. Sixth, don't sell during corrections out of fear. If your thesis was sound when you bought, a price decline doesn't invalidate it unless fundamentals have changed. Selling low locks and losses. Holding through volatility gives your thesis time to play out. Seventh, don't expect linear progress. Markets move in waves, not straight lines. Bull markets have corrections. Bear markets have rallies. The overall trend matters more than daily noise, but you need the emotional constitution to endure the noise. Eighth, don't confuse price targets from analysts with guarantees. Nobody knows where silver will trade in 6 months or 6 years. When someone gives you a specific price prediction, they're guessing. Educated guessing, perhaps, but guessing nonetheless. Make decisions based on probability and risk management, not predictions. Finally, don't stop learning. Markets evolve, conditions change. What's true today might not be true tomorrow. Stay curious, read broadly, think critically. Update your views when evidence warrants. Rigid thinking is as dangerous as emotional thinking. We've covered a lot of ground. Let's bring it together. Silver has corrected sharply after testing significant resistance. This has shaken confidence and created doubt. But when you examine the fundamental conditions, unsustainable debt, currency pressure, supply constraints, accelerating industrial demand, the case for higher prices over time remains intact. Corrections in bull markets are normal. They're necessary. They shake out weak hands and create the foundation for the next move higher. If you study market history, you'll see this pattern repeat across every asset class and every cycle. What matters now is not what silver does tomorrow or next month. What matters is whether you understand what you own and why you own it. If you're positioned in silver because you understand the monetary dynamics we've discussed, because you've accepted the volatility, and because you have the patience to let the cycle play out, then corrections are just part of the journey. If you're considering silver, understand that there's never a perfect entry point. Markets don't wait for everyone to feel comfortable. The time to position yourself is when conditions favor the asset, even if sentiment doesn't. Right now, conditions favor silver over the long term, even though sentiment is uncertain. This isn't about getting rich quickly. It's about preserving purchasing power in an environment where currencies are being systematically debased. It's about participating in what could be a historic repricing of monetary metals as the flaws in our current system become undeniable. It's about patience, discipline, and understanding cycles. The financial landscape is shifting. The old certainties are cracking. The assumptions that guided investing for the past decade, that central banks control everything, that debt doesn't matter, that inflation is dead, that fiat currencies are stable, these assumptions are being tested. And when assumptions get tested, those who prepared in advance benefit, while those who clung to conventional wisdom struggle. Silver sits at the intersection of these shifts. It's both an industrial necessity and a monetary asset. It's relatively affordable compared to gold, making it accessible. It's volatile, which creates opportunity, and it's historically undervalued relative to the monetary chaos we're likely to witness over the coming years. None of this is financial advice. You need to make your own decisions based on your own situation, risk tolerance, and understanding. But I hope this conversation has given you framework to think clearly during uncertainty. Stay educated, stay disciplined, stay patient. Understand that markets will do everything possible to separate you from winning positions before they reward you. That's not a flaw in markets, that's how they work. The final shakeout might not be over, more volatility might lie ahead. But if you understand what you're watching, if you manage risk appropriately, and if you maintain emotional control, the next phase of this cycle could be remarkable. Preparation beats prediction. Patience beats panic. And understanding cycles beats reacting to noise. Thank you for your time and attention. Stay thoughtful, stay informed. And remember, the best investments are often the ones that feel uncomfortable right before they work.